Good morning, folks. Hope everyone out there is having a good start to their holiday shortened trading week. Just getting this edition of Back to the Futures going. Give me one moment as I get all the streaming components live. And overall, my feel is markets are looking a bit heavy as we get into this trading session. And I've got a lot of interesting information to present this morning. Just about to get into the slides, and then we'll dive into Bookmap. All right, let's get this show on the road. Welcome to this week's edition of Back to the Futures with me, Markets and Mayhem. And we do have a little bit of mayhem on the menu, it would seem. Markets that are heavy, seeing, well, let's go through the slides here. But what I'm seeing suggests we could still have some more downside from here. First, as always with anything, manage your risk first and foremost. Do not risk more than you're willing to lose. That is really the basic premise of trading. Managing your risk first and foremost so that you always have enough liquidity in your portfolio to keep trading. If you're not trading that way, you are in essence gambling, and that generally is going to hurt. You might get lucky a few times. That luck won't serve you well. A bit about me. I've been trading these markets and investing in them for about 20 years now. And it's been a pretty awesome journey. I have to say, I've learned more about myself and the world around me from trading because it necessitates both a journey of exploration inward to get to know your own psychology, what kind of trading style works best for you, as well as getting to know the world around you, how the markets work, what feeds them, the really big elephant in the room, which is global liquidity. But also, it helps to define what works for us running this business we call trading. Because after all, what we're doing is buying and selling inventory, hoping to repeatedly capture a positive spread. That's our profit. It doesn't need to be dressed up as something sexy. It doesn't need to be talked about as if it's a path to instant wealth and riches like people tend to do when they're embellishing. I think it's much more constructive to talk about trading as a business, run it like a business, and give it that same level of attention to, again, managing that risk first and foremost so you can keep those doors open. For me, that's been all about taking a systematic approach. I do some discretionary trading, but most of my trading is systematic in nature, and that means driven by data. It also means that I have ways to qualify that data that are more objective. So, back testing, looking at indicators that I've created and otherwise. And we'll get into that, including the next ones, which are these data driven weekly pivots. These are levels that I do not want to see the market move below. And unfortunately, we're below the ES pivot as we get into this trading day. It suggests that we're going to open below it, and we're likely to challenge the NQ pivot as well. I'm going to post these on social. And these pivots are driven really by a combination of price action, volume profile, and some special sauce that my algorithm uses. I find that looking at these pivots on a week by week basis helps to find whether I'm going to come into the market looking more bullish or bearish on a swing time frame. So on a swing time frame right now, we are looking a bit more bearish for a number of different reasons, not the least of which are the technicals. Look at the Nasdaq. Is this a head and shoulders pattern? It could get there if we crack that pivot for the week. We could start looking more like a head and shoulders pattern, which would be pretty bad for a market where the AI narrative is becoming a bit more challenged. We certainly do not want to see this level cracked and that continued challenge of whether or not generative AI is something that can lead to profitable business models in the future. So far, that MIT report that suggested that 95% of businesses investing in generative AI have nothing to show for it has rattled confidence in some investors. Add to it, we do have some very powerful open source models coming out from DeepSeek, from Alibaba, the Quen models that challenge some of the dominance in the commercial space of AI. So, from a technical perspective, but also from a narrative perspective, we are seeing some greater challenges coming in to what's been driving this bull market. Add to it, the New York Stock Exchange is showing signs continuing to be overbought here with over 75% of its issues above the 20-day simple moving average. This is an indicator that often gives us signs of froth when we get too extended to the upside, and it's continuing to flash that signal here and now. Often is the case, this can resolve with either a correction or consolidation, but given how the market is trading and the shift in narrative, it does seem more likely that we could see a correction. Another thing that's important to consider, we are in the most difficult period of seasonality for the year. That means that September, by and large, is a down month for the Nasdaq and for the S&P. It tends to be a month where you see more volatility coming in as well. It's an up month for the VIX most of the time, down month for the major indices. So for me, I'm definitely treading more carefully. I've been raising cash on some of my longs, talking about getting out of the Google swing trade, the Tootsie Roll swing trade, and a couple of others that have been big winners. I'm still very bullish gold and silver. They're not impacted by that same seasonality. You can see silver now cracking new 52-week highs this morning, and gold cracking new all-time highs recently as well. The precious metals are still in full focus. I'm still very bullish on them, but the broader market's much more cautious. Let's talk about the SPX options visualizer levels. The big one that I think will be worth watching today is going to be the put wall at 6,400. Price action this morning implies we're going to open below it. So that could definitely put a bit of a challenge into this market. I think it's going to be important to watch this carefully as well. And basically, if we're closing below SPX 6,400 on a daily closing basis, that opens up some pretty chunky downside. We could get down to the next level that could develop into a put wall around 6,300. The next thing to consider is the gamma level. These are levels that we calculate to determine whether or not the environment of how market makers interact with price is changing. Currently, we're in neutral gamma. What that means is that we don't have that much of an impact from dealers on price discovery. However, if we push into negative gamma by 10, 20, 30 points, you can start to see the impact that's going to have. What that tells us is we're going to get into an environment where dealer flows change, and it's more likely you could get into a chase dynamic. That means that dips could be sold, rips could be bought, and that exacerbates overall volatility. So be mindful of that chase dynamic if the market continues to push lower, which, by the way, the implication of today's pre-market price action is that we would open up deep enough into negative gamma that it would begin to have that impact. So looking at markets suggesting they're going to open up down 1% or so will put us into that negative gamma environment that we should be watching for today's trade. Another issue is overhead. We have a very large wall of calls at 6,500. We've seen some roll up to 6,600, but overall, that is a formidable level of resistance. Recall the first time we hit it, we backed away. We've backed away since then. And below us, you can also see there is this wall of puts at 6,400. Not quite as formidable, but perhaps it could be an area the market climbs back to during today's trading action. However, I'm going to be more interested to see how these positions evolve. Again, September tends to be a pretty challenging month, so I would expect trading desks looking at seasonality to hedge at lower strikes. So I am looking for some roll lower, perhaps to 6,300, 6,200, maybe even some increased exposure at 6,000 during the month of September. On average, the S&P falls about 4% during September. So this first trading day would put us right on track for the sort of seasonality that we're used to. Now, I do want to share a couple of exclusive deals. The big one here is Bookmap. You can get up to 40% off. Visit TraderAid.com/bookmap, scroll down to the special offers, and your first billing period will have that exclusive discount. You're also welcome to check out what we're doing at TraderAid. You can use the code Mayhem20 at TraderAid.com for 20% off your first billing period. And the folks at Bookmap would love for you to join them on their Discord server, discord.com/invite/bookmap, or use the QR code on screen. And with all that said, we are going to dive right into Bookmap here ahead of the market open. And we can see here about 15 minutes ahead of the market open, this has been a pretty choppy overnight session. I'm just zooming it all the way out. You can see when Globex opened, we dropped right off the open, had a little bit of a pushback to make a lower high, then made a lower low, lower high, pretty marginally lower low. Then we really tried to break out of this pattern, and there was just no relief for buyers. You got to make a higher high than the previous, but then the big drop happened. And that big drop happened. It gave us a little bit of a relief bounce, and now we're seeing that drop accelerating. So pre-market, you've got a lot of negative momentum in the European auction especially. That gives me a sense that we could get some continuation. We've seen the market consolidate into this resolution. There was also a ruling over the weekend that essentially the tariffs are illegal. They'll still be in place until perhaps this decision is adjudicated by the Supreme Court. Now, I personally believe the Supreme Court will hold them up. I don't want to get too much into politics. I'll just say that's my base case. But I will also say that all of the narratives that are happening right now are less bullish for this market. You have the AI story challenged. You have legal challenges to what has overall turned into a trade war with a lot of reconciliation between some of the trading partners, some of it by force. But if this tariff situation continues to be one that's challenged, that can certainly also be problematic for these markets, because the worst case scenario is the U.S. has to return over $100 billion to trading partners, to companies, to anyone who is paying the tariffs, wherever they were paid. If they are ultimately ruled illegal, that money would need to be returned. That's the big fat left tail risk that you still have to keep in your head, even though I feel it's personally pretty unlikely to come about. Now, shifting gears to the calendar for this morning, the big event to watch is U.S. S&P manufacturing PMI. We're going to get the final numbers at 9:45 a.m. Then we're going to get U.S. ISM manufacturing PMI at 10 a.m. Both of those, I should say, are going to be quite important, particularly the 10 a.m. print. We're going to get prices paid, employment, and spending. I think it's going to be important for us to see prices paid come down. Employment, I don't expect much improvement from. If we look at the prior readings for these numbers, US ISM manufacturing prior reading was 48. The forecast is for 49 on the headline. Prices paid before. The prior reading was 64.8. The forecast is for 65. Anything above 50 is expansion. You do not want to see those prices continuing in the mid 60s or higher. What that's telling you is that the supply chain is experiencing input costs that are on the rise that could either be passed through to consumers in the form of inflation or could eat up margins in the form of earnings coming down or some combination of the two. And then on the other side of it, obviously the employment numbers there are something to keep an eye on as well because they have implications for the broader economy. While manufacturing isn't the bigger chunk of our economy, it's services, we still have seen a rolling recession in the manufacturing industry on and off for really over 2 years. Well, let's zoom out on the NASDAQ in the overnight session as well. We'll see a similar picture here. We didn't quite get that bump up on the last move before the decline like we saw in the S&P, but overall the same thing. You opened up with a bit of a gap down, some pressure that continued to a series of lower highs and lower lows, and then you had that larger puke. Now, this is something that's important if you're trading and you're just trying to get a very simple understanding of micro trend. That is trend that's playing out over the course of minutes and hours rather than days and weeks. This is a micro trend down for the very simple reason that you can see lower highs and lower lows. That's all you really need to qualify a micro downtrend. Doesn't mean that the larger trend is in the same. I would say right now the Nasdaq's more in a consolidation that's leaning towards potentially turning into a downtrend. S&P, you can't even make that argument. Right now, the S&P still looks structurally decent, which is probably one reason why the New York Stock Exchange shows more overbought conditions than the Nasdaq, which has already started to roll lower. I will also say for our own indicator that looks at Nasdaq momentum, it gave us an early indication earlier in August, in fact, that structurally components in the Nasdaq were beginning to roll over, that momentum was beginning to wane ahead of some of this volatility. Also note that that Powell pump that we got from Jackson Hole, pretty much gone now. And that move didn't really make a whole lot of sense. If we really think about what Powell was saying, he was telling us that, sure, we'll consider cutting in the face of stubborn inflationary pressure that we can't qualify. And yes, the labor market is a concern of ours. Basically, Powell's telling us there's greater risk of stagflation, and he's going to lean into his inner Arthur Burns in the final chapter of his legacy. That's not great news, as yes, in the short term, rate cutting into a reasonably strong economy, certainly not a bad thing for stocks, but you can overheat. You can have the fiscal side run hot and the monetary side run hot. That can bring back inflation. And that in and of itself can be problematic for markets and the economy. That's the risk that they're running with the sort of policy, dual track policy that they're trying to push from the White House down. And we've seen this before. The Biden administration made similar mistakes. Remember when inflation was transitory? So this is something that we've already seen. Policymakers are already aware of some of the risks. Granted, we don't have a global shutdown, but we are risking juicing more demand than what supply is able to provide. We are seeing just a little bit of pre-market option flow here as well, suggesting that there is interest in hedging lower. So it is something to keep in mind. I think that we will see some degree of acceptance of these lower levels during the trading day. Whether or not we get continuation lower is a different question. That's going to be what we're watching in the first 20 minutes of trading, establishing that opening range and also seeing where some of that earlier S&P 500 index options flow that tends to lead the market is taking shape. Important to note, too, that where we are right now is an environment where 0DTE options have a greater influence. They account for about 60% or more of daily volume in the S&P 500 index options, and that is a pretty significant change. There was quite a while where they were less than 50%. Now we're seeing 60% or greater as a relatively regular phenomenon. And good morning, folks that are just tuning in. Welcome. If you have any questions, let me know. Just going to bring up a different view of the market as we get closer to the open here. Give me one moment. So this is just looking at the market through a slightly different view. I wanted to show this confluence area here at key 6 negative with the 63.94 pivot. So far, we are seeing some support here. We also have the magnet level of 6406.25 coming into play. And overall, this has been structurally heavy. You can see we've had a number of fair value gaps that were bearish that have led into this continuing move lower. So this is something that gives us a sense that, again, coming into the market, this is looking pretty heavy. Of course, we're going to get some continuation of last Thursday, last Friday's flow, basically whatever wasn't capped off in the end of the week. In the beginning of today, we also have beginning of month flows coming in. But overall, we have a structurally precarious look, somewhat bearish look coming into today's trading, especially as we've pretty well rejected the weekly pivot in the overnight session. And we can see similar in the NASDAQ here. We're coming into a confluence area, rather large area of potential support. Here's our weekly pivot right here in the gold. So we can see we're testing that weekly pivot on the NASDAQ. We're also testing that put wall. We're seeing some support come in here. So it's really going to be about what happens in that first hour of trading that sets the tone for today. Zooming out, the NASDAQ has a pretty bearish look to it overall. It has a bit of a head and shoulders look, especially if we see continuation below the 23,113 pivot, 23,113 pivot. If we do break below there, that next pivot level on a swing basis comes into play. That's 22,585.75. We can see it is acted as support previously. So that's the risk we're running where we are right now. Having broken below the 21 moving day exponential average, that's also something to take into consideration, is that's been a pretty important indicator for momentum that the market had been trying to hover above. You can see when we break below it, we often do get some continuation lower. So we'll be keeping this handy. We're seeing the first positive fair value gap on the S&P 500 futures really for the whole overnight session, just starting to print on this next candle here. And we are 4 minutes ahead of the market open. We also had a headline earlier this morning. U.S. pulls TSMC's waiver for China shipments of chip supplies. So a little bit more trade war escalation with China where there really hasn't been a resolution. That's one of the areas to continue to monitor is the situation with China. And folks out there, if you have any questions, let me know. Got a question about how to use iPads in the YouTube Bookmap chat. I will say I don't think Bookmap works on an iPad natively, but you might be able to use the web version on an iPad. I'd defer to the Bookmap team on that one. Vincent says the dumbest thing is today making a long trade on Euro versus USD and not checking news. Yeah, I mean, it depends on how one trades, right? I've seen folks that don't really even look at the news do quite well. I've seen other folks that are event driven traders do quite well. It's all about your trading style. But for me, the ultimate anti-dollar bet that I have on is long gold, long silver, long some of the higher quality miners, and that's worked out quite well for a while here. One of my favorites, Rio 2. I think it's up like 150% since I put out a note on it in February. So that's a tidy little gain, 150% in about 6 months, 7 months. Not bad, right? And for what it's worth, I'm still long Rio too. I'm not, that's a long term holding for me. That the cost basis I think is like 15, 20 cents. It's trading about a buck 30. Vincent, I'm not sure what your total portfolio liquidity is and what $100 means for that, but my thought would be for any trade, don't take it unless you have a plan, and that plan should start with your risk management. The reward is secondary. It's always about managing the risk first and foremost for every single trade. Markets are open. We are seeing some selling pressure continuing here on the market open. That is pushing us below that next pivot as well. And so here you go. You can see we're crushing that 63.94 pivot and now key 5 negative confluence area, getting down to the 63.81.50 pivot on an open where a lot of sell delta volume is coming in. These candles on the bottom are not just aggregates of volume. They are delta candles, just like we see in Bookmap. So it looks like we're just about to test that 63.81.50 pivot short order here. And the selling pressure relatively aggressive. Let's flip over to the NASDAQ. Quite a similar look there as well. Selling pressure right off the open, some degree of aggression. Getting past where we saw some of the interest in Friday's trade in puts as well. Meaning some folks coming in today probably not hedged for this type of a move over the weekend and into the first trading day of the week. And you can see NASDAQ pulling below the point of control, S&P pulling below the point of control, which was pulled lower as well. Both of these look pretty darn bearish. Ivan Robles asks in the chat, and I apologize if I mispronounced your last name there, Ivan, can I use Bookmap for small caps? Yes, often is the case that you can. In fact, I've done that myself, and it's pretty darn fascinating to watch their order book in Bookmap. So when we were playing the squeeze game, when hedge funds were really, really, really irresponsibly short, I would use Bookmap to watch the order book in those squeeze plays, and it gave me invaluable clues for entries and exits. So I'd say yes, it can be done. DX Feed is a good way to watch that data as your data provider. Brant Ford asks, what indicator do you find most beneficial? That's a pretty big question. I would say for me, and I'm going to talk my own book because, I literally use this stuff. I built it because I use it. The SPX options visualizer for me has been invaluable. And I've built that out now for the NASDAQ, Triple Q, SPY, IWM, and all the Mag 7 stocks. I'll be putting all those variants of the indicator live, hopefully this week, but very soon. But the SPX options visualizer is live. You can learn more at traderaid.com/SPX. That's been a big one for me because options really do drive the market. And then second to that, the pivots that I showed you on this other screen have been extraordinarily helpful for mapping levels of resistance and support. So we're looking at these pivots here. We talked a little earlier about watching 63.94. It had been support. Having crushed it, we're getting right down to that 63.81.50 pivot. So overall, we can see how these pivots can be quite actionable even during the overnight session. You can see this week's major pivot acted as major resistance during the early AM session. And I like that confluence between the put wall and this pivot here. It just adds a little bit more validity to how important that level is to the market. So pivots and options visualization. I know you only asked for one indicator, but those are the two for me that I use quite a bit. I did admittedly build them, so I am talking my book, full disclosure, but these are indicators that I built because they help my trading, and I've heard feedback from others that they've helped their trading as well. So that removal of TSMC's waiver for China shipments of chip supplies will take effect December 31st. So it's not necessarily immediate. Getting just a little bit of a bump. I don't know if it's necessarily from that news. And we do see some interest building in lower prices. You can see that on the heat map with these bids coming in after market open, starting to grow, particularly around 63.75, 578 contracts on the bid. And I have a comment from the chat room from Vincent. I like order book volume profile and market profile. Even the DOM bookmap is kind of out of my budget for now. Can I trade Forex and use the software for trading for a prop? I believe there are prop firms that use Bookmap that allow you to use it as a part of their trading, but I would defer to their team on that. I don't trade, funded accounts. I have no relationship with any prop firms. I just trade my own capital, and maybe call me old-fashioned, but that's what I've been doing for 2 decades. So I don't really, want to trade other people's money and deal with all the weird rules they put into that. But that being said, if that's your jam and you do well at it, more power to you. And in terms of trading Forex with Bookmap, I don't know that it has native support for that, but you can certainly map out Forex futures contracts for things like the euro and the yen and otherwise. And we are seeing just a little bit of a reversal here. Just getting back above the 63.94 pivot here, or at least challenging it. That's also key 5 negative. That's an area of noteworthy put exposure on the SPX chain converted to ES levels. This confluence area gives us some sense of why this level is important. And that also lines up with the point of control, which has just been pulled a bit lower. So again, gives us a sense as to why that level is important. Now, this is likely to be more of an opportunity to reoffer than just a V bottom being put in, but we'll give it just a little bit more time to take shape. We've only got about 9 minutes of trading after the open here. I like to look at the first 20 minutes to form that opening range and also just to get a better sense as to where the options flow is coming in. And I'll note that right now I don't have the high-low indicator on. I will enable that later to more clearly define the opening range, but for today, I'll eyeball it just to give us a sense. So far, it's reasonably chunky, suggesting we could have some decent range expansion today. It does look like we're getting rejected at that point of control. Again, this is a pretty formidable downtrend. I don't know that it's going to correct in a miraculous V-shaped recovery in the first, 10, 20 minutes of trading. I still think we could have some more downside to explore. You look at that overnight session too, you get a sense that that's some pretty determined selling that's only become more aggressive in the pre-market session and then in today's regular trading hours. And you can look at the session volume profile from the overnight. I mean, this is just sellers are dominating pretty much every level. And the buyers that came in at these higher levels are so far off sides, they've probably already stopped out. But if they haven't, they will soon. You can see a little bit of green in the session volume profile here as well. These are strikes where the delta on the volume was more on the buy side. Again, those folks all very offsides. All these sellers from higher levels patting themselves on the back because they're quite in the money at this moment. It's one reason why it's important to watch that session volume profile. It's basically delta by price for the session. Being able to see that gives you a sense as to who's aggressive at what prices, and that can give you a better sense of the market dynamic you're getting into. And this is a pretty broadly distributed sell down for what it's worth. I'm just going to put the heat map on here from FinViz to show you all. There's downside across much of the S&P. There are some exceptions here with things like Pepsi, T-Mobile, Merck. But overall, this is a decline that is spanning multiple different sectors. Tech seems to be the heaviest, but it is by no means isolated to tech. So that's something to keep in mind as we're trading this market is the downside is being more distributed. Last week, it was more focused in tech. You could even call it a rotation into safer parts of the market. Today, it's pretty broadly distributed across everything but some of the more defensive sectors. You're seeing a little bit of resilience there in pockets in certain companies. Another thing that I think is probably worth looking at real quick here is just what's going on in futures, and particularly gold and silver. Silver coming off its highs, but still trading above $41 for the first time in, I want to say, what, 12 years or so? It's been a while. And I think silver has room to $48. I'd be watching it and really using the 50-day moving average to manage risk. Gold, a very similar risk. It's breaking out to new all-time highs. I would also use the 50-day moving average on gold to manage risk. You can see how it's honored it overall. And I really focus on the weekly closes for that 50-day moving average. But we can see precious metals are taking off here with increasing uncertainty, and silver being pulled higher for the ride has a lot of catching up to do versus where gold has gone over the last 2 years. And for the market itself, this still looks like a heavy market to me. And the reason I say that is if you zoom out to these 5-minute candles, it's still lower highs and lower lows. In fact, right now it looks like we're just forming another lower high here and potentially heading back down to that 6381.50 pivot. So still leaning bearish. We talked about the market looking heavy coming into this week. Certainly not disappointed by that analysis. It looks like we could have continuation of this theme. And I will reiterate what I said pre-market, that September is the most challenging time of the year based on seasonality, averaging down 4% or so over the last 5 years. And we did get S&P manufacturing PMI final coming in line, the headline number at 53 versus a forecast of 53.3. That's the preview. The really big PMI number coming in at 10 a.m. with a forecast of 49 for the headline, 65 for prices paid, and 45 for the employment index. And we're just hovering around the point of control in the S&P futures. NASDAQ futures looking a little bit more sprightly, pushing above the point of control after that head fake lower. So NASDAQ actually looking pretty good here in this recovery bounce, making a higher high versus the prior high that it had made. Sellers are certainly trying to exert their impact here, but you can see prices just hovering higher. So you're seeing a divergence between how the S&P is behaving and how the NASDAQ is behaving here. And we're starting to see initial options flow coming through the S&P 500 chain. So we'll be keeping an eye on those flows here. We're just about 2.5 minutes away from forming the 20-minute opening range as well. This looks like it'll be about 15 handles or so. Not too bad. And S&P starting to resume its journey lower. Let's see what the NASDAQ is doing in comparison. Also seeing some pressure, but still closer to its session highs. And we're seeing interest build in lower strikes in that put flow on the NASDAQ 100. We are seeing some strength in crypto this morning after a rather nasty weekend. Bitcoin looks like it may have put in a bit of a bottom overnight, now rallying. See if we can bring that up on screen here. We'll just backfill this data going back, let's say 12 hours. Doesn't look like I'm able to pull it back quite. Oh, there we go. All right. So that reversal started around 8:45. Just about 108,350. And you can see from there into that move, there was a pretty good amount of aggressive selling. Perhaps the sellers got a little bit ahead of themselves, particularly this really exhaustive delta candle here. And whatever inspired that reversal, it was off to the races. It's been almost vertical since. This is a real V-shaped type of bottom recovery in Bitcoin, up almost 3,000 from those lows now. So that's a pretty meaningful turnabout, perhaps part of that helping to inspire the recovery in the NASDAQ that we're seeing now trading towards new session highs. And you can see that aggression coming in. There's more aggression on the buy side coming into the NASDAQ here. You're seeing some sellers getting stopped out. And you're seeing call interest all the way up here to 23,475. S&P 500 now finally breaking to new session highs, making that push above the point of control, seeing some meaningful aggression on the buy side as we approach as we approach ISM manufacturing PMI at 10 a.m. Eastern. Also seeing some interest in higher prices offer here at about 64.30 coming in, and another one at 64.25 and 64.20. So you can see the market wanting to express that liquidity at higher prices as well. And if we zoom out, we can see the hot call implying around 64.50 as a level of interest from S&P options, converting those over to S&P 500 futures levels. That is an area to watch, as well as this warm call and key one negative level that has confluence with this white horizontal line that is VWAP. So there is some reasonable confluence just overhead around 64.20 to watch on our potential journey higher to the hot call. But I will note with all that, flow into puts is certainly noteworthy here. The hot put trading 5,000, the warm put trading 4,000 here. Some potential hedging flows happening in this AM session. This is often when they do happen within that first half hour to hour of trading. A pretty large stop run just taking place here. 421 contracts to the buy side. Those are shorts, probably from this area of the session volume profile, being forced out in this move higher. And that does make for a reasonably interesting opening range here as well. It's about a 20 handle opening range. So that does give us a sense that this could be a pretty dynamic trading day. As does the range in strikes. This dispersion between the top and bottom strikes here gives us a sense that options are also pricing in some degree of range expansion, given that we have about 100 handle spread between the hot call and the hot put. We are approaching US ISM manufacturing PMI top of the hour. Forecast is 49, with prices paid forecast at 65 and employment at 45. What we do not want to see would be prices paid continuing in the mid 60s or higher and employment continuing in the mid 40s or lower. That could cause some short term pressure. But for now, what we can see is there still remains interest in higher prices. The hot call rolling lower to where the warm call was prior, and more offers building overhead, including a rather large one at 64.30 with 830 contracts. So one question I got from Vincent is, how is the latency? I will say on Bookmap it's imperceivable. You're pretty much as close to real time as your network connection allows you to get. And I use Rhythmic for my futures data. I use Bookmap data for the Bitcoin and other cryptos, and I use DXFeed for ETFs and stocks, and all three have been really, really robust. Occasionally, like with any other data provider, you might have a hiccup here or there, but overall, it's been smooth sailing. Biggest thing is to make sure you're using a wired connection, that you have a high quality internet connection. I prefer fiber optic wherever available because you're going to have the lowest latency traveling at or close to the speed of light. Now let's quickly go back to this view. This is the pivots charts that I have. We can see S&P 500 bottoming out right here at key 6 negative, getting close to the 6381.50 pivot. We saw a reasonably bullish fair value gap that was a part of this move. It was also an outside candle, so it gave us a sense there could be a trend change coming in, and the most aggressive delta volume in this most recent candle, suggesting buyers taking control here. Let's also zoom out to this chart of the NASDAQ. We talked about that weekly pivot at 23,113. So far, that level, which has been support for quite a while, it's been pretty formidable, that's holding so far. So if we zoom in on the NASDAQ here, we can see how that level was challenged and ultimately resolved higher with two bullish fair value gaps as well, giving us a bit of a sign that we might continue that push. And that head fake lower taking us just about down to the 23,021 pivot confluence area with key 1 negative and the put wall. So that was an area of confluence, pretty formidable support. So far, that has held, giving us the ability to bounce above the weekly pivot and to the most active call strike on the NASDAQ. So we do not see flow continuing to move higher. That could be it for this move so far. Let's see what the data tells us in 2 minutes. Be careful trading into these events because the order book tends to lighten up, particularly around price, meaning your fills could be much less ideal. Generally, and you could see that. You could see the order book heat map lightening up, showing there's less liquidity on bid and offer as we get into this event. That event being US ISM manufacturing coming up in 1 minute. Headline forecast 49, prices paid 65, and employment index forecast at 45. $20. 5 seconds until data. You can see the bookmap heat map is just pretty much gone. Lower than forecast, 48.7. Prices paid coming in lower than expected at 63.7. Employment index coming in lower than expected at 43.8. New orders coming in better than expected at 51.4 versus a forecast of 48. So to recap, ISM manufacturing PMI coming in lower than expected at 48.7 versus a forecast of 49. Prices paid coming in lower than expected, 63.7 versus a forecast of 65. And employment coming in lower than expected at 43.8 versus a forecast of 45. Overall, it's a mixed reading. The headline number isn't great. It suggests we're in contraction still, somewhat deeper, as we're below 50, which is the even number. Anything below 50, contraction. Above 50 would be expansion. Prices paid reading coming down modestly, which is good, but still 63.7. And then employment showing more signs of weakness, now 43.8. So I'd say overall mixed bag, but within expectations for all of the data. So a few questions as we wrap up the stream that I wanted to address real quick. First one, so Starlink connection is out of the question. I would say that depends on your experience with Starlink in terms of packet loss, in terms of jitter or the variability of your latency, and then in terms of nominal latency. If you're able to run 1,000 pings to a reasonably stable host, let's say 1.1.1.1, that's a Cloudflare DNS, you run 1,000 pings to that and it's coming in at like 50 milliseconds or lower and you're not seeing any packet loss, then it should be fine. But when you're delivering that signal from your router to your computer, you should wire in. Starlink is using basically line of sight satellite technology, so there's not really a lot of obstruction between your receiver and its satellite. On the other hand, if you're using wireless in your house, you've got all kinds of potential interference. If you're somewhere where there's other folks nearby, you've got your neighbors and all their devices, but even in your own home, you have all your Bluetooth devices, all your wireless devices, even running the microwave can potentially interfere if it has some leaky radio frequency coming through, let's say the shielding on it, which sadly often happens with microwaves. It's just much better to use Ethernet wherever you can. Short of Ethernet, you can use power line networking where you're using your internal circuit as a network to basically in lieu of Ethernet. Wireless tends to be the least reliable networking technology. And when you're trading and when you're using, information that can come in at high volume and bursts, it's best to have that wired in wherever possible. And then the other connection I had was, can you show me the limit orders as liquidity on the chart? That is the order book. Everything above spot price, these are all offers. Everything below spot price, these are all bids. And you can see that in the heat map. The heat map colors based on those limit orders. So again, order book is all limit orders, red offers, green bids, and the heat map is colored off of those offers and bids as well. So I want to thank everyone for tuning into this week's episode of Back to the Futures with me, Markets and Mayhem. My last take on where we've gone so far is that if we don't continue to see flow build up and the NASDAQ at higher strikes, that move may be closer to done for now. With the S&P, it's starting to look a little more tired, but the hot call does imply we could get back up to that weekly pivot here. So overall, bit of a mixed picture, but does suggest range expansion is in the cards with about a 20 handle opening range. Watch the flow and watch the price action. Until next week, I'll see you 9 a.m. Tuesday for the next episode of Back to the Futures with me, Markets and Mayhem. Thanks for tuning in.